All right.
There we go. All right. Thank you, everybody, for showing up. This is the second month we've been doing this. We got a lot of great feedback last month when it was just me and Eric. This time he decided he wanted backup, so we ended up bringing in his heavy hitter, Josh Jones, one of the team leads in underwriting for Movement Mortgage. And Eric has some fancy title he changes every other week. I think he's assistant VP of underwriting, something like that. Is that right, buddy?
I am the lowest person on the totem pole. I am an underwriter. Underwriting live.
He's Mr. Fix It to me, which is what matters. But I didn't have, last time I had a prepared list to kind of warm everybody up, but I don't have that list this time, my friend. So let's just jump right into it. Anita, do you have anything pressing, anything new?
I want to sit in the back of the class.
No, you can't do that.
How do I move to the back?
You got anything good? No?
Circle back.
Circle back. Okay. I'm going to throw some easy ones that were sent my way this week, and I've already answered them for people, but maybe they'll be helpful for the other agents. If I have a FHA buyer, another lender told this FHA, this guy that has an FHA loan on his current home, if he buys another home, which will be his primary, that he'd have to put 10% down. Is that true?
I've never heard of the 10% rule.
Yeah.
Eric, have you?
I have definitely never heard of a 10% rule. There are three major things that you can do to purchase a home with a second, or to get a second FHA loan, but 10% is definitely not in it.
Oh, he wasn't even, here's the funny part is he wasn't even looking for an FHA loan. He's going to go conventional this time. But there are some exceptions to have two FHA loans. Could you cover those for me?
Over 100-mile transfer.
Yep.
Increase in size, and it actually has to make sense. And Josh, what's the third one I'm missing? If you're getting a home,
You can co-sign for somebody else. You can be a non-occupying co-borrower.
yeah.
I think that's it. Yeah. So if you guys didn't catch Eric's second response, the second one was if you're increasing your family size. So let's say we have a buyer who purchased a home and it was just him and his old lady. And then throughout the years, they've gone ahead and acquired 3 or 4 rugrats. Now that 2-bedroom rancher or shotgun house isn't really cutting it anymore. So if they buy a larger home and it makes sense, then boom, they can still use the FHA. All right, I call in another realtor. Latoya, hook me up. Give me some questions. Even if it's not on the buyer side, give me something on the listing side that has bothered you or confused you or has tripped you up.
Yeah, I was just trying to think about that. I don't have anything right now. I'm sure I do. I'm just trying to think through some past scenarios and what might have been helpful. But I am another one that if you could circle back to me, that would be great.
Okay, sure.
Well, let me ask you, you're probably tired of this question, Chad, because I'm sure Relda's been bugging you about it, but I'm like working on representing a seller right now on a condo, which is not common for me. This is only the second time.
Sure.
And I'm hearing the term warrantable in terms of obtaining financing on the house. And of course, I've been like trying to Google it, but I'm still not. Is that something that you guys are familiar with, or you don't do condos too often either? Or?
No, so Movement's unique in the fact that not only do we do condos, but we have our own condo team. So they have their own everybody, underwriters, processors. They have experts that all these guys do are reach out to Fannie Mae and get stuff get stuff approved, reach out to FHA, get the condo association approved where it wasn't already. Stuff like that. So we have a dedicated team for that. So it's definitely a difference. As far as warrantable, I mean, it's hard to give you a full definition, but basically what we're looking at is this a place for, there has to be a certain acronym or I'm sorry, not a certain acronym, certain percentage of primary residents there. I'll tell you what, it's easier to explain non-warrantable. So now we're talking about condo tels is what they call them nowadays. And these are the places that were built specifically for the Airbnb crowd. So stuff that's being rented out by the night, that's not going to be warrantable.
Okay.
Places that are like 50% commercial. So you'll see some buildings in Northern Virginia that have a lot of like storefronts, restaurants, businesses inside in the first couple floors. Then it's condos up top. That might be questionable. Whether it's that condo association is warrantable or not, or applies for a condo warrantable loan, the easiest way is to reach out to your lender and have us do the research for you. So what I did for Relda this week is I reached out to the condo team. First, I did a quick search that I can do on my own, which is on the HUD website for FHA, see if it's been FHA approved. It was not. Doesn't mean it can't be. Once again, we have to investigate that if they need to move forward. And then I reached out to them to see if Fannie Mae had approved it. It wasn't on the Fannie Mae website as being approved in the past, but they did their own research on the condo and everything looked up the stuff. They thought that it would be fine moving forward. Now they couldn't give me 100% solid yes, because it wasn't my client. I was doing her a favor for a lender that wasn't doing this for her. So
Right. Okay.
really should get him off his butt.
On a side note on all that, we also work with the buildings to get them to be FHA or Fannie or Freddie qualified as well. So
absolutely. And so the ones in Colonial Beach is what I was trying to circle back to, they're going to be fine. And just because they haven't been certified before doesn't mean they can't be. So it's just all about doing paperwork.
Okay.
Yeah, you got one yesterday.
Another avenue other than talking to the lender is depending on the condo association, usually they can answer that question for you too.
Yeah.
But
Yeah.
a hot topic this week, out of your office, that was the hot topic. I was getting calls from her, Nikki, everybody.
Well, because they have, units above, one's above the other one.
Yeah.
Yeah.
How about you, Eric? Did you get any tough questions this week? You can jump in on. None for me, of course.
one of, I don't know if it would help a realtor, but FHA variable income has been the topic of conversation all day today. If a borrower doesn't work a consistent 40 hour or work 40 hours every week, it is not considered full-time, or it would be considered variable income that we would have to use an average on. It's really hard to explain it, but
The way it defines it is variable versus fixed. So even in like situations where they may work consistently 40 hours, if that's not supported and shown as guaranteed and actually fixed, then like Eric said, we have to treat it as variable and end up using an average over the past couple of years.
So even if they worked, I mean, some of these people, employers nowadays are trying to get out of paying insurance and stuff. So they'll say, oh, they're full-time and they work 36 hours. So you're saying that would be considered variable?
if they work 36 hours every week and year-to-date matches up, then that would not be considered. We could use the 36 hours. The biggest thing is that we'd have to be able to make sense of it. Anything in the state of Virginia, 32 hours or more is considered overtime, or I'm sorry, considered full-time, and that employers have to pay full-time benefit and insurance on them.
Gotcha. Okay, I have, there's a recent one that I'm aware of, that FHA bond program, and she was in college for the last 3 years, and then she just started a new job. She was advised to get full-time employment. As long as her VOE and her pay stubs show 40 hours consistent for the last, let's say 30 days, you're good to move forward on that, correct?
I might have missed the part. If year to date and everything supports it, then yes.
Yeah. So, I mean, we're talking about brand new job though.
Yeah.
So
Um,
you would just need a
it-
BOE and you would need a, what, at least one pay stub, is that correct?
30 days.
30 days.
So as long as everything lined up, then yes, and it's in the same line of work that they went to college from, then I would okay that.
Yeah.
Even if the first pay stub was a little bit off, sometimes we can get a letter from the employer stating that it was their first week and that it was orientation and that they don't work 40 hours. So as long as we can make without a shadow of a doubt that they are working 40 hours and everything is combined, then I would be okay with doing it.
And that's, ladies, that's one of the main reasons we advise don't change jobs during the transaction. I get asked that a lot up front. Most people are good about asking before they do it, but we're big on making sure they don't change income types as well. You don't want to go from salary to hourly and that kind of thing. So, and with Eric, I think you and I had one VHGA, of course, your favorite, last year that she changed jobs mid-transaction, and I think she only got one pay stub, and it was off, and it was government, so it was a pain in the butt to get them to verify, and it was a hot mess. So, but we got through it, got them in the home. That's what matters. Let's see here.
Chad, I do have a question.
There we go.
So I know right now a lot of people's student loans are in deferment. So what does that mean in terms of like, how is that impacting their qualifications now, whether it's conventional or FHA?
I'll take it first.
Eric?
No, go ahead, Eric. Go ahead.
Depending on the loan type, every loan type, they're going to have to be out of deferment, depending on what they're, depending on FHA is going to say that they need to have paid 3 months.
No, she's saying student loans, brother.
I'm sorry.
She's not talking about being deferred on their mortgage. She's talking about student loans.
Okay. So
And I'm sorry, let me clarify that. I guess what I'm saying too is a lot of people's student loans right now have been deferred due to COVID, so they're automatically deferred. And I mean, I guess they could make payments, but a lot of people are choosing not to. So I'm wondering if the impact on that.
gotcha. So it's not, as long as their payment history isn't showing behind and there's no default or anything, and they are being deferred, then it's going to be that we're going to count either 1% or 0.5% against them, as long as we can document that payment is zero, or we're going to have to use their payment. I had one today that actually the employer or the borrower went into an IBR out of their deferment, and we were able to document that, which on a conventional loan, we can use the payment of zero as long as we document that their IBR payment is zero.
The biggest thing.
Go ahead, Josh.
No, I was just going to say I ran into that a couple of days ago, and what happened was they were on an IBR payment that said that their payment was $140 a month, but they went on automatic deferment when their servicer put them on deferment. So we weren't able to use the IBR payment because they were currently on deferment. So we have to show that deferment has ended in order to use the IBR payment if we're trying to use an IBR payment.
Okay.
So that answers part.
Yep, that makes sense. Thank you.
And
Student loans get really weird.
IBR, in case you guys aren't hip to that, just means income-based repayment plan. But like Eric was saying, I mean, really, we're looking at counting, because they changed the rules a few months ago. It used to be 1% or 0.5%. Now we're counting basically half a percentage point of the total balance as their monthly payments. Generally not much, unless they have like only one student loan and they have like the entire experience covered under it. Most of the clients I see have 10 small loans. Some of them, you would be surprised, they owe $50, but it's in deferment, so they refuse to pay it. But
what's nice about FHA recently is they've actually switched to more of a conventional guideline, where if the credit report shows a payment and they're not in deferment or anything, then we can use that actual payment, just like on conventional. Whereas if it's a $0 payment reporting, then we have to use the 0.5% calculation.
Yeah.
So it kind of depends on whether there's a payment reporting or whether it shows 0.
Correct. Yep. So at the end of the day, Latoya, unless they're in default or they're in default before deferment happened, it's not going to affect anything but their debt to income ratio. So it just affect their purchasing power is all. But the default thing that is important because there's had one recently where her student loans were in default. Half of them were anyways prior to COVID hitting. And COVID hit, they automatically went to deferment and she thought she was good. Well, that's not the case. If they're still in default status, you can't get a government loan. It's not going to pass the sniff test. So we weren't able to take her FHA. We had to work on her credit, build her score high enough that she could go conventional. But it's a good topic. Appreciate you bringing it up.
Speaking of credit, I don't know, I guess you look at people's credit a lot, but this kind of find this interesting because I only look at my own. And obviously I refinanced my house a couple of months ago and my credit score went down like 30 points. I guess, is that just because you have 2 loans recorded for a little while, looking like you, or
the biggest thing that I've learned on that one is that you closed out an account, but you have an open new account, and credit reports don't like new credit.
right? Okay.
And it
And then
should
my-
only be a temporary drop.
Yeah, well, and then my husband was noticing this morning, like he paid off a business loan that he had. He owns a company and he paid off the loan he had. And his credit score went down 30 points, like after he paid it off last week or whatever, so maybe 2 weeks ago. So it's very interesting, like how, because he didn't take out a new loan. He has no debt now, and it went down. It's kind of interesting.
Yeah.
Yeah, my wife's credit score actually disappeared recently because she had no credit reporting on her credit. So yeah, because it factors in the average of the length of your credit history. When one of those accounts is closed, it reduces the average of the length. So that's why.
Okay.
Yeah, absolutely. Right before I jumped on this call, I was on a call with a client in North Carolina, and he's like, "Oh, I just came into a bunch of money and I want to pay off my collection accounts." I was like, no. As soon as you do that, unless you get convinced those guys to delete them, you're making an old boo-boo a new boo-boo. So it's going to show on there. There's a little acronym that says DLA, date of last activity. And it's going to show a 0 balance, which is cool, but it's going to show that collection as making it look brand new instead of an old problem, basically. So it plays a big factor. So sometimes it's good to take care of collections, sometimes it's not. That's why I always prefer, if your clients come to me first, let me do the credit analysis, let me work with them on that, tell them what to pay and what not to pay, because sometimes they goof themselves over when they think they're doing the right thing.
Right.
All right, we got one young lady in the middle that's not talking. Rod, what you got for me? She's not gonna say nothing, is she? Latoya, hit us with another one.
I do have, just from like a listing perspective, when you are walking through a property and clearly you see like, the HVAC is, in disarray or whatever the case may be, what are some of the things that when we're walking properties, we should be looking out for to determine whether they're going to be financeable or not?
I'm gonna let Eric and Josh tackle that one, but I've also got an appraisal cheat sheet that I'm gonna send to you in an email as soon as we're done with this. And it's a little blurry, but if you print it out, that'll tell you line by line, okay, this won't qualify for conventional, this will, but you guys can give her the basics if you want, how I looked that up.
I was just going to say,
Okay,
your cheat sheet would probably be 1,000 times better because there's going to be a lot on it. Like VAs step down quite a bit, but if you have peeling paint and the house is was before 78, then that's something to look for if they're going to do VA, or if there's 3 steps to get onto the porch and there's not a railing, then you're going to have problems. As far as like, as you're looking through and you see anything visibly obvious and they're not going to do a home inspection or anything, then I would be pointing that stuff out as possible things that might need to be corrected in order to purchase the home.
Right.
But there's just so many different things based on the different loan types that we'd be here for a little bit.
Oh, yeah, it would be a long conversation. Conventional itself is a long list, but a big one that's come up several times this year for me, Latoya, is the heat source. So on some of these more rural homes, some that are a little bit choppy, maybe do it yourselfer kind of thing. I'm gonna pull up the reg here and see if I can't find it, but source of heat should be present and in working order in all homes. Air conditioning is not always required, but if an AC unit is in place, it must be in working order. That's pretty basic, but what I was getting at was there were some circumstances where like a wood stove would qualify, and there's some there where it doesn't cut it. Basically, they want to see heat being pumped into all the rooms, or at least have access to it. So just something to consider. A lot of the stuff is basic, in my opinion. I mean, some stuff is picky, like Erik said, the paint. But most of it's just, I mean, it's common sense. Like if you wouldn't want to live there, you might have to question it, double check this list I'm about to send you.
I show so many houses I wouldn't want to live in. Like a lot of them.
Well, the big thing is safety. Like I hate when, people bust on VA loans, and I'll let Erik get into VA loans a little bit too, because we talk about that all the time about how they're really good loans, but listing agents are scared of it because they're like, oh, well, they're too picky and they're so blah, blah, blah. Like, no, they just don't want their kids, some military guys' kids moving into a house with black mold in their bedroom. I know that's crazy, but would your kids live in that bedroom? Erik, can you talk about for a couple minutes, kind of a segue? Can you tell Latoya and the others, on the listing side, why they should think twice about accepting a VA purchase offer, and why you think VA loans are good loans?
Well, luckily you got Josh and I that are both funny because we're a company known for doing VA loans. But I mean, the biggest thing is a VA loan is probably the most easily approvable loan out of all the loans. The ratios can go up higher on a VA loan than they can, the ratios can go up higher on a VA loan than any loan that there is. The AUS is more forgiving for the most part on a VA loan. You're able to get approval easier. It's 100% financing. So for the most part, 99% of the time, unless they have another VA loan. The requirements for the appraisal side of it have definitely gone down over the years. Yes, you're going to have to get termite and a moisture inspection done. But like what Chad is saying, why would you, honestly, in this, I'm from Virginia Beach, so I'm definitely not going to not have a termite and a moisture. And no matter what loan type I buy, I live it. I live 6 inches off of the water. But the other part of it is it's just a benefit to, my biggest thing is it's a benefit to the veteran who's obviously either active military or has served long enough to receive that benefit. And I mean, it's an easy loan, plus we're saying thank you.
I have a question maybe for all the agents in the room, because I've never been an agent, but what are some of the hesitancies in VA loans when you get an offer from a veteran? What are some of the reasons why you might not want to accept that over another? If anybody has any.
I mean, I think there's only really one big reason, and it's just because, on the upfront, they don't really have any skin in the game. So especially when you're looking at like multiple offers and you have people that are putting down like 10, 20%, and the VA is 100% financing, you always worry about like if something does go into default, you really don't have anything there tangible to really protect your client's interest.
Gotcha. Yeah. So like Erik was saying, with 100% financing, the majority of VA loans don't actually require any down payment from the veteran. In most cases, they're just getting back the EMDs they've put into it. particularly if there are seller concessions covering a lot of the closing costs, which, as I understand, seller concessions are becoming more common again. So, you know, on the same level that Eric was saying, the VA takes a very practical approach to approving a borrower's debt to income ratio. It's not just based on the number. They look at their total income and what it looks like they're going to have left after all expenses. So for the most part, that helps us, because where a lot of programs will be limited to, 45% DTI or 50% DTI, in FHA case, 56.99. I've seen VA loans approve as high as 75, sometimes 80% DTI if they have high amounts of income. So it's crazy, but they're looking at the residual income, the amount that they have left over. So you're kind of safe on the down payment side. Sometimes they don't need it. The approval's more flexible. So VAs are great loans. They're pretty solid.
But I have a question about the whole, so if you have an FHA borrower, a conventional borrower, and a VA borrower, and you were talking about the money that they have to put down onto the loan, how does that affect the decision on the realtor side? Because if each one of them puts $1,000 earnest money deposit down, isn't that the part that you guys would be worried about when you could do a 20% down conventional loan and 100% down VA loan, and I can approve the 100% VA loan a lot easier usually than I can even, especially an FHA loan, because there's a reason why you're going FHA. I would rather have a VA loan just from the thousands of VA loans that I've underwritten in my life. I would rather take a loan that's $500 earnest money deposit from a VA or from a veteran than I would a 96.5%, 3.5% down FHA person who put $10,000 down, because I would be more scared of not being able to approve an FHA loan than I would a VA loan.
No, I agree with that. And Eric, that's what I was going to mention next was your seller's not going to have their hands on that down payment. So who cares how big the down payment is? It's the EMD, really. And the reason I bring up the VA loan thing isn't to beat up on any of you. It's just being a veteran myself, it just gets old, I guess, hearing not from you guys specifically, but from some of the blue hair brokers, I call them, the ladies that have been in the game for 40, 50 years, that, things have changed. Times have changed. Appraisals have changed. Loans types and qualifying factors. It's not, they're teaching their people that they're not good loans. And I just hate to see, veterans out there struggling. So anytime I get in front of a group of realtors, I always start trying to sell the VA. I have no skin in the game. Movement does every type of loan. I get paid the same regardless of the loan type. I just want to impress on you guys that they are good loans, and these two guys bend over backwards to make it happen for those veterans. We don't charge any lender fees. I had one that we just closed. I posted it on social media because I was super proud of it, but this is Stafford. This isn't out in the middle of nowhere. This was a, $450,000, $500,000 home in Stafford, clear to close in 14 days. And she had a 591 credit score. It's insane. 591 credit score, 14 days, appraisal and everything. And by the way, the appraisal came in, value was higher than what the sales contract was. So she made out good. So they're not bad deals. Let me see. I think of some other topics.
Some of the common ones are disputes on credit. Eric already mentioned variable income. That's always a big one.
Mm-hmm.
Trying to think of anything else that comes up a lot.
I'm just reading my emails as they're coming in right now. My job is, mine and Josh's jobs are to make loans work. So it's, we get questions all the time. We had a borrower that couldn't take their ex-wife off the loan. So what are we going to do about that? Which just means we're going to count it. Let's see. A lot of closing issues today.
That's Friday.
Yep.
How about some particular challenges with bond loans? Because, I do quite a bit of VHDA, and the agents, they're familiar or semi-familiar with VHDA and the benefits for first-time home buyers, but some people don't understand the extra stuff we have to do for them, the extra hurdles we jump through to make it happen.
Actually, one thing I'd like to say, I mean, hurdle wise, we'll go over all that, but I actually just had this happen today on a bond loan. Borrowers have to be really careful that when they Google stuff, that they're getting the most up-to-date stuff. One thing about guidelines is they can change daily. So we had a borrower today decide that they were going to pull the requirements on a Virginia housing loan and send them to the loan officer and say, hey, this is what Virginia housing says. Unfortunately, like with our logins and stuff, we can see the most recent stuff. And I actually tried to find what they were looking for, and they pulled it from like 5 years ago. With everything with COVID, it changes hourly sometimes on what we're going to do.
Yeah.
Bond loans as a whole are a really good thing. It gives people an opportunity to buy a home that may not have had the opportunity. There are going to be extra conditions. There are going to be extra things that we have to do. It may impact how fast we can do it. Where movement as a whole, we say that we can do stuff in 7 days. Bonds, we are not going to guarantee that. Is it possible to do one? I think the fastest I've ever done is a 4-day Virginia housing loan. How about you, Josh?
I can't remember the fastest I've ever done one. I mean, we can do them pretty quick. It really all depends on how fast we have the information we need, because part of it is we have to usually send off, specifically in Virginia, we have to send it off if there's an MCC for VHDA to look at. So the part of that lack of being able to get it done as fast as there's another party involved. So
I joke,
but we're still pretty quick.
Yeah. I joke with Chad all the time about bond loans and my dislike of them. I mean, in all, like a VA loan, it is a great thing for a borrower to take advantage of. And if I qualified for it, I definitely would use Virginia housing if I was to buy a home in Virginia or Maryland bond or whatever it may be. Every state has them. But there are going to be a little bit extra conditions and stuff like that Virginia housing is going to ask for, and they're a little bit less lenient on certain things. There's a credit score requirement. There's other things that they're going to look at that where a straight FHA loan or conventional or even VA, they would not.
Yeah, definitely. And then most recently for me, and this goes to all the agents, is the importance of returning the paperwork in time. I've got one closing Monday that we're still waiting on the seller affidavit, and this was provided to them week 1, So, and that turns into a snowball of pressure, right? So people will be like, oh, Chad, why aren't we closing? And then I'm calling Erik, like, Erik, what can you do for me? And it snowballs, and nobody within the chain is going to be happy in those scenarios. When we receive the task, it's just important to knock them out and do it. You can do it via DocuSign. They're very easy.
I can honestly say, if I can give any advice on anything, is to reiterate to anybody that's purchasing a home, like as soon as you sit with them, that when the lender needs stuff, how important it is that they get it to them. Rushing stuff toward the end, I've seen so many times. That's pretty much what my job is where at the end of the day, we're trying to get a loan into closing, and the borrower just gave us everything the night before because now they're going to close the next day, and we find something that's wrong. My biggest words of advice is, if they're going to go through it, explain to them that, it's stressful and it's not always fun, and we may ask for something that they might not even imagine why we're asking for it. And trust me, I don't ask for stuff if we don't need it. And my team is all the same way. Josh is unbelievable with his team. But the sooner that we get stuff, it only speeds up the process. It makes the loan go by so much smoother. If we have a loan that goes into closing a few days early, we're reviewing it to make sure that it's absolutely perfect, that it's absolutely the best thing that we can do for the borrower, and anything else possibly that could be done, as compared to when, we're closing tomorrow and my loan officer's been asking for my pay stubs. I better get them to them. You'd be surprised how often that actually happens. So it's my biggest words of advice is when they come in and you go to show someone a house and they get their contract ratified. I have tons of friends that are agents. I'm popular today. I mean, I've even dated an LO, so I definitely understand like how hard their lives are, but yeah, just getting everything in that we ask for as quick as possible so that we can fix any problem that comes up as soon as possible, and closing goes by smooth and they're not sitting there at the closing table because I mean, we can't release them until a wire is ordered, and it takes usually over an hour just to get the wire to completely transfer through. So if we have everything all taken care of and we've already been in communication with title company 3 days in advance and everything is going good, then we run a lot less risk of having any issues.
Absolutely. Well, before I do last call for questions, Erik, in the very beginning, I interrupted you because you misunderstood Latoya's question about deferment. She was talking about student loans, but since deferment's ending soon on mortgages, can you give us the latest and greatest? And yes, I do know that it changes daily for COVID. What's the latest and greatest? If one of these nice ladies has a client that comes to them and says, I want to sell my house and buy another house, and they're currently in it's not deferment, what do they call it for mortgages?
Forbearance.
Yeah. So what's the latest and greatest? What do we have to do?
I mean, if they currently own a home, the biggest thing that I would do, like if I was an agent and I was showing someone a house and I know that they have a loan, I would just nonchalantly ask them if they have a house and if it's in forbearance. If it's in forbearance, warn them that it's going to be out of forbearance. There's not a loan program that we're going to do where we're going to close on a loan that's in forbearance. The other part that we're going to have to do is verify that they're not delinquent on any of that. Is the Reader's Digest version of it. Every loan type is going to be different, but I would, if they say that they have a loan that's in forbearance and you're going to be selling their current home and you're getting them a new home, I would immediately like, hey, I need you to reach out to Chad or whoever your loan officer may be, and say that they need to start looking at this right away because it's going to be based on a couple different things.
Yeah. Now,
Could I add on to that real quick, Chad?
Yeah, go for it.
Exactly like Erik said, the sooner they can get out of forbearance, because most programs are going to require 3 months of timely payments after they've exited forbearance. So, totally agree with what Erik said. The sooner they can get out of forbearance on any mortgage there and start making those regular payments, the better off they're going to be.
Okay.
And I found out the reason behind it. I mean, you have the big banks. I'm not saying that Movement Mortgage is small by any means. I think we're the number 7 lender in the nation. 6.
Well,
We went down.
Now.
So by any means, we're definitely not small. But some of the things that like Wells Fargo, if they own the loan, they'll hold them in forbearance. And I've actually seen this because they're going to be able to do, I mean, as far as the refi side of it, they definitely killed it because of the stuff that they can do against their own loans is a lot better. So they know that, hey, do you want to continue your forbearance? Hey, do you want to do this? Because the only lender that they're going to be able to use, even if they can't stand Wells Fargo or they can't stand, well, I found out yesterday that Rocket's in tons of trouble. And I actually Googled it and they are. We got some civil suit issues. So we'll see what happens to them. But banks are pushing for that because that's holding them in there. And as far as the refinance side of it, if they own it and they can keep it without having to do a refinance and they're getting more interest now because they bought the house 3 years ago at 5, but they're continuing to hold them in forbearance and the borrower's not even thinking about doing a refi or purchasing a new home, then yeah, they're going to do that. And then if they do decide to go buy a new home, we're going to have to say no because Fannie, Freddie, we underwrite by government standards of Fannie Mae, Freddie Mac, HUD, and also VA, where they can come out and do their own thing and say, hey, we're going to do this, but we're going to hold you to this, this, and this, and then we're going to make you pay back this, this, and this. I've done a lot of looking at it, and I mean, it's borderline predatory lending in my opinion, but because the borrower is signing off on everything and they're not really understanding what's going on when you put a loan into forbearance, or they're allowing them to skip payments and call it whatever they want. They're just excited to go 6 months without making a mortgage payment. And they're not reading the full contract. Some of the stuff that I have seen where they're adding on a complete HUD second and the borrower doesn't even realize that they're doing it is crazy to me.
Absolutely. Now, are you seeing that they have to catch up altogether? I mean, I know you said it depends on the program if they have to make 3 on-time payments or not, but are they having to catch up all at once before they can get a new mortgage? Or
Josh, is it Freddie that we can on a conventional where if they're selling their current home and they were behind, that as long as we can prove that they paid off their current home and all delinquent part, that we can move forward?
Yeah, on conventional loans, they have 2 paths if you have a forbearance on a mortgage. Number 1 is reinstatement, which basically means that they've paid back in a lump sum any missed payments that they've had. And we can document that all the missed payments have been made up for. Number 2 would be the 3 months proof of payments. So in that case, we would need the deferment agreement that they get once they exit forbearance. And that basically tells the borrower how they're going to pay back those missed payments. And so typically we're going to need 3 payments based on the forbearance agreement that they received from their lender. And so that in that case, they don't have to pay back everything that was missed. But in a lot of cases, it'll be tacked onto the end of the loan. So in that case, as long as we have the 3 months timely payments, typically the amount that they missed is going to be paid off whenever they sell or refinance that mortgage. So we're not worried about that if they've made the 3 months. FHA doesn't allow for reinstatement. So FHA specifically and VA as well require 3 months. They don't allow reinstatement with some.
okay. All right, ladies, before we wrap this up, last call. Any questions? We didn't stump them. Next time I think I told Eric last time I was gonna keep a log, but just so darn busy and I answer questions, via text sometimes on the weekend. But I'm gonna keep a log of good questions and hammer you guys next time. But Anita, you got anything?
No, I think I'm good.
Yeah. All right. Well, you enjoyed dockside there, the beach.
You act like you know what I do on Friday nights.
Dockside. I want to go to Dockside. Oh,
Yeah.
wait, I'm not talking about the restaurant.
Come
Virginia
on
Beach. Sorry.
down.
Run down. Latoya, last call. Anything for you?
Nope, great. Thank you for the help.
Yeah, absolutely.
Ed, I just wanted to offer real quick. I know you guys probably don't love reading guidelines as much as me and Eric do. But if you ever need a resource for a specific loan type, just let Chad know or let us know, and we can send you kind of the links we go to find those answers. So if you're interested, we can send those to you.
You go to the links. I used Google. Wikipedia has the answer to every guideline question.
Wikipedia, huh?
You sound like that borrower you were just talking about.
Yeah, right.
Well, all righty, guys. I appreciate your time, both of you, taking time out of your busy day. Josh is not even working today, and he did this for us. I very much appreciate that. Eric, it's Friday. He's slammed. Appreciate it, brother. And thank you, ladies, for showing up. I'll see you guys later.
Thank you, Chad.
All right. See you guys. Have a good afternoon.